Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.
You're watching Stockwatch. I'm Ndawuleng Lechela, and joining me to unpack your stock-related questions today are Graeme Körner from Körner Perspective and Cobus Potgieter from Southern Cross Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Gents, thanks so much for your time today. So a new week, and it seems like we are kicking it off on the back foot. What is fueling the nervousness in markets, Cobus? Or are traders, or markets just taking a bit of a breather after the rally we saw, especially in US markets last Friday?
Yes, profit taking in the simplest terms. Actually the South African market is up a little bit as of midday today, largely supported, of course, by the gold stocks. So gold clocked a new all-time high, and gold stocks performing in line with that. So our market, of course, outperforming its global peers today. But generally, we saw ourselves and the US clocking record highs on Friday. So a little bit of a pullback, somewhat expected across the rest of the market.
And on the back of that, Graeme, Cobus mentioning, the gold price and how that has been fueling the resources 10 complex here at home, as well as some of those gold counters. There's a question here. Has the toppish bell rung on these stocks? They are pointing or asking about the gold counters as well as the platinum counters. We've also been seeing a rally there.
Yeah, I'm Ndawuleng. I would say in gold it's quite difficult to call. Clearly, there's a new rocket burner under gold. Seeing what we're seeing today. I think part of that probably related somewhat to the Fed, but also growing concerns, I think, around debt in certain geographies like the US and the UK. I think if you've got gold shares, if you're lucky enough to hold them, you don't want to sell them right now. It looks as though there's another leg up. But yeah, I think in terms of platinum, platinum and palladium price also up today. And for me, that's actually the sector that makes more fundamental sense. You saw Valterra, for example, going through 1,000 on Friday, a little bit weaker today in spite of the metal prices. But I think on balance of arguments, I think things like Valterra are looking quite interesting to us. And I think there, for me, the big story is just that supply and demand dynamics are shifting. A small shift back to ICE engines, even if in the form of hybrids, could catch a fairly tight market if you look forward on the medium term, very flat-footed. So we quite like the fundamentals in platinum, but we'd probably play it in a cowardly way in something like Valterra.
And what about you, Cobus, in that PGM space, those locally listed counters? Which one comes out tops for you?
I'll toe the line, and I feel sorry for any quality or value manager in this environment, myself included, and I suspect Graeme as well. It's hard to be overweight gold when one is looking for a robust business model with pricing power and a moat, and these guys are absolute price takers. We've been a little bit pragmatic, so we have added a bit of Harmony and Pan-African, and that's because they are marginal producers, and you're getting a significant amount of the upside, a significant amount of gold beta from the marginal producers. But overall in the precious metal space, our top pick is also Valterra. It's the sort of highest quality, most boring pick, but ultimately if this sort of shift in the cycle the trend continues, it'll see significant upside, and of course it'll be more protected to the downside if the thesis for the PGM metals doesn't play out quite as expected.
All right, let's move over to the US tech counters. A question coming through from a viewer here saying, off of the back of the fine on the H-1B visa, how much of an impact do you expect that to have on tech counters, Graeme?
I haven't applied my mind to it. You know, we've had these sort of visa bans and restrictions in the past. Thinking back probably 5 or 6 years, maybe a bit more than that, and it didn't really hurt them too much. Yeah, but I think it may impact the long-term prognosis of the US as the technology hub of the world. That's really kind of, wouldn't say lunatic fringe, but that's long fat tail, out there into the future. I don't think it's going to have a massive impact on them on the short term.
Let's move back to some of the local counters. A viewer here asking for insights into Sappi, Afrimat, and Truworths. Any insight into why these companies' share prices have fallen so sharply would be helpful, Cobus. Putting you on the spot there.
Pretty on the spot. Look, performance has been, all of their recent results have been disappointing and poor. If I had to choose one, and that's, I guess, bottom fishing from the three, I think Truworths is starting to demonstrate excellent value.
Yeah.
A little bit brave, maybe a bit of a falling knife, but we're at that stage in the credit cycle where we suspect that the pressure in terms of the credit loss ratios should alleviate, and the consumer certainly is looking more and more positive over the last few weeks. So we think that cycle is slowly shifting, and hopefully Truworths, given that the PE is significantly lower than the dividend yield, which is sort of a silly but relatively robust historical buy signal, it's one we like at this level.
And what about you, Graeme? Maybe let's zoom in further into that clothing retail sector. Truworths is up against the likes of Mr. Price, the likes of Pepkor and TFG.
Yeah, look, we like TFG. There's a strong case to make for Pepkor as well, obviously very much on the front foot. It's amazing. Pepkor is such a giant in terms of footprint and their market position, just their sheer scale. And yet from a listing point of view, it's one that really doesn't get a hell of a lot of attention. So I think Pepkor is a really good business. We like TFG. I think some of the offshore operations, it looks as though there's some headwinds there, but we like management. We like the positioning, because they've got a good spread of brands which targets kind of different LSM groups. And I would agree with Cobus. The consumer's been under pressure for a very long time. It would have been lovely if the good governor and company could have given us some more good news on Thursday, but that didn't happen. But you sort of get the feeling as though the mood amongst consumers is starting to improve a little bit, and probably the aggregate of the rate cuts that we've seen so far is helping. So I think the clothing retailers or retailers generally are looking very cheap. Mr. Price has a great history, but I think in that sector, I like Truworths very much, but I think Pepkor is also a very, very powerful one. But you know what, I think if you buy what Cobus is saying, and I think there's merit in it, there's just such a low base here. A little bit of good news will go a long way. And these are all good quality operators.
Yeah.
They're well diversified, well run, balance sheets are strong. So yeah, I don't think you can really find fault with any of those four.
And just looking at, consumer resilience, I know the retail sales figures are backward looking, but they've been strong for most part of the year. The last print for July, I think sales were up over 5%. So yeah, it seems like, consumers are filling up their baskets, whether it is clothes, whether it's, your necessities like your everyday grocery items. And talking about grocery items, there's a question on Boxer. Cobus, has the question rather reads, Boxer hasn't done much since its IPO. Is it a buy or a failed IPO?
Boxer is the only real growth story in South African retail.
True.
And for that reason, it has attracted, a pretty heavy valuation. So I like Boxer, I like the business. Maybe the last set of results were in line to slightly disappointing at best in terms of the trading update. But ultimately, I agree with the general sentiment of Graeme that the retailers are reasonably, the clothing retailers in particular. But okay, switching to groceries, I like the sector as a whole, barring the landmines of your Spars and your Pick and Pays. So on that note, the Boxer valuation inside of Pick and Pay, that is sitting at a very wide level. So despite the fact that I don't like the rump assets inside of Pick and Pay overall, the value there, just on the underlying value of the Boxers, is showing such a significant negative value relative to NAV that I think Pick and Pay at this stage provides an attractive entry point into the Boxer.
And that was going to be my next question. There's always a question from viewers around whether entering Boxer through Pick and Pay is the best way, considering that Pick and Pay is priced lower than Boxer itself. Graeme, what are your thoughts around that? Entering Boxer through Pick and Pay or buying Boxer straight?
I suppose the question is whether you think Pick and Pay is actually really worth negative value. If you think it is, and it's forever broken, and ShopRite will never allow them to, claw their way out of the trenches, then you probably buy a Boxer directly. But I think there's a better than average chance that Pick and Pay itself, in spite of the fact that it's an incredibly competitive landscape with a very, very strong incumbent in ShopRite, I think they will get it right. But I suppose it's about the clarity of what you want. If you like Boxer and you don't really like Pick and Pay, as Cobus was saying, then maybe just don't second guess it and buy the one you like. I buy the Boxer growth narrative, but for me, the multiple relative to some of the others is a little bit full. And although there is a lot of runway, again, Boxer doesn't have an open goal. There's some very powerful competitors in that space. So I think I didn't participate in the listing, and my sense is, like usual, I'd want to get my arms around it, see a few results before I really make a call. But it's a really waffly answer to say, if you think that Pick and Pay is worth more than nothing, you buy a Boxer through Pick and Pay. But just be aware of the fact that the market is discounting a reasonable amount of growth in that share price.
The viewer here asking for the panel's views on CA sales and Omnia.
Sure. No, I don't have a view on either of those two.
Graeme?
I'm afraid.
Yeah, not on CA. Look,
okay.
on Omnia, I think there's a sense that it's right for some corporate action. So I think if you that way inclined, I think Omnia could be an interesting play. But the reality is, I think as Cobus said, there's just so much value. Quite a few higher visibility, I would argue, higher visibility corporate action plays. So I think it's a difficult business, and it's a difficult business to turn around. And I think they've got some underlying components in their businesses, or let's call them silos that are not performing. So I would probably steer clear of it unless you're a corporate action player.
Okay. And talking about turnaround strategies, PPC saying it's making progress with its turnaround strategy, Cobus. I think they said that the estimates, or rather that EBITDA jumped more than 20% in the 4 months ended July, but they are reporting some margin pressure in SA. What have you made of that update? And Are you betting on that turnaround story? It seems like they're quite bullish on, I guess, infrastructure and, I guess, demand for cement, even building that cement plant in Cape Town.
Yes. So, I mean, I guess it's in two parts, and we are only looking at a 4-month comparable. Sometimes these trading updates don't have great transparency, but in any case, so the South African Botswana business seems to be expanding somewhat on a revenue basis, significantly more on an EBITDA basis in terms of margin expansion. However, there were some tailwinds with regards to plant downtime being in the base of the previous comparable period. So it's hard to get a normalized view on that without looking at a longer period. Zim somewhat inverse, significant uptick in revenue supported by tariffs being introduced for cement imports in that market. Of course, they are a local producer, so they saw significant volume expansion as a consequence of that protectionism. But conversely, because of plant downtime, margins a little bit under pressure there. But still, overall, significant operating profit expansion. And I think importantly, they've actually been managing to externalize the profits through dividends out of that Zimbabwe business, which is always important when you're in a, call it a currency-controlled environment, as Zimbabwe tends to be. I think they've externalized 12 of 18 million USD. So a pretty positive outcome. And overall, the tone of the update is incredibly bullish. I like the name of the turnaround play, and we do have a little bit of it on. It's one of those things where if they end up pulling off this turnaround, there will be significant upside still on the name.
And the last time I checked, that share price was up, I think, over 3%. Graeme, is this a turnaround strategy you're betting on?
Well, I suppose it is. I mean, if you think of where it's come from in the torrid history, I think the problem is, or the problem was for PPC. I think it's changed over time. But if you look at Sepaku, for example, newer plants, probably more efficient. When you're competing against Afrimat, they're good operators. So it's not, again, it's not an open goal. I would maybe offer a slightly different view. I think, whichever of the cement plays you want to play, or however you want to play them, if you've got to have a bullish view on construction in South Africa, and us, creating the capacity, and whether it's government or parastatals or the private sector. If you take that view, then I would argue you've got to be constructive or positive, not unintended, on the construction sector. In which case, if I look at somebody like Wilson Bailey, that I think is a very, very well-run business, it's come off a fair amount over the last few months. I would probably rather just play Wilson Bailey. I think you get a lot of the levers, probably with a little less forecast risk, and the valuation also looks very compelling. So respectfully, rather than playing a PPC or any of the others, I would probably just go and look at Wilson Bailey.
And just on the back of that, Cobus, just talking about the bullishness on the construction sector, what do you make of a play like Raubex, right? That's been getting a lot of those projects from Sunraw.
Yes. Raubex, it's been a pretty good one. Ultimately, some questions around the quality of the earnings, but ultimately, just to reiterate again what Graeme has said, if you like the thesis, and there is the sort of reinflation and further development in further investments in infrastructure push coming through from the top levels and the GNU in general. It should continue to be supportive of these names, and Raubex seems to be a significant beneficiary of these infrastructure projects. So yes, I still like it, but similar to Graeme, I prefer WBHO.
Okay, let's move on to a totally different sector. Graeme, the viewer here asking the panel for their thoughts on Bidvest and whether you see any improvement in the next couple of months.
Improvement, are you talking operationally or share price?
Share price.
Well, let's yeah, I suppose they're talking share price. Look, I think, for a very, very long time, I've had the view that that the Bidvest share price was just a little bit rich. To me, in many ways, it's kind of a GDFI, real GDFI kind of play because they're just so well established in so many of their markets. But the price has definitely come up to the point where you sort of feel you're being compensated. So I think it's an incredibly good quality business. Obviously, ironically, when Bidvest and Bidcorp split, Bidcorp was the international operations and SA was Bidvest with sprinkling, and now they're very much getting, opening their horizons and looking offshore. So, yeah, I think both Bidvest and Bidcorp look compelling. I think my sense is that Bidcorp probably is the better play. I think it'll probably deliver, in hard currency terms, similar, if not better, earnings growth. And the valuation is not ridiculous. And arguably, when you're dealing in the world, there's a bigger market out there, and they also are very good operators. But don't take anything away. I think Bidvest itself is looking cheap, so you can't guess what market prices are going to do. But my sense is, like so much of SA Inc., it's looking really cheap, and I would argue that the risks are probably asymmetrically on the upside, unless the sky falls on our heads.
And I saw you agreeing and nodding there, Cobus, Bidcorp versus Bidvest.
Yes, their last most significant deal into the hygiene cleaning services industry. The market wasn't particularly fond of that, and they are entering two very competitive markets that they don't have as much experience in executing in. But it looks like if they manage to bed that acquisition down over the next 12 months, and it starts to de-gear a little bit, we'll see a bit of an uptick in earnings, and that'll bring some credibility back to management overall. So yes, I agree with Graeme. I like it, and this seems to be a historically cheap level to get into Bidvest.
All right, then let's get into your stock picks. Graeme, I'll start with you. Where are you seeing opportunity at the moment?
Well, value-oriented people will even go and look in the technology space for value. And that's what I think we found. PayPal, which, technically is sort of somewhere between financial services and technology. It obviously fell from grace in sort of 2021. And my sense is, as so often is the case, there's nothing wrong, really, I don't believe, with a company. We can discuss, the threats from, DeFi and crypto, although I think they are actually quite well placed there, because I think that industry does need some guardrails. But to me, PayPal has got a really good franchise. New management, let's call them, focuses very much more on bottom line than just chasing numbers. Some interesting developments in the pipeline that I think can sustain them for a while. But the bottom line, coming back to the value argument, you're looking at a business that's probably going to deliver 12, 13, 14% earnings growth on a 12 multiple. So for something that is quasi-tech, technology or IT, but has a foot in the FinServ camp, I think PayPal's looking unloved and unrewarded for what's actually been a fairly consistent job over an extended period of time.
And what about you, Cobus? Where are you seeing value at the moment?
My pick is a bit more obvious, but also in the tech space, Naspers. So it has performed incredibly well this year already, and is our preferred, entry point into an AI narrative for any given South African investor, and its exposure through Tencent in particular. The reason for that, and the reason I would choose that over Prosus, is that it is historically cheap relative to Prosus. So we saw in late 2023 a sort of secular narrowing in the wake of a corporate simplification process and a share buyback program announced on both of those. And it isn't since 2023 that we have seen Naspers at such a wide discount relative to Prosus. The discount to Tencent isn't as wide as it's been more recently, but just relative to Prosus, this looks like a very attractive entry point. And at the very least, I would be switching all of my Prosus exposure into Naspers at this level.
All right, let's leave it there, gents. Thanks so much for your time today. That's all for Stockwatch today, and thanks to our guests, Graeme Körner from Körner Perspective and Cobus Potgieter from Southern Cross Capital. Up next, it's The Close. Stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.